The auditor's responsibility under SA 810 is to read the other information presented with the summary financial statements and identify whether any material inconsistencies exist between the two. If the auditor identifies a material inconsistency between the summary financial statements and the other information, they should discuss the issue with management and request that the other information be revised to avoid any misrepresentation. If management refuses to correct the material inconsistency, the auditor should include a statement in the audit report highlighting the issue to ensure transparency and clarity for the users. The auditor's report on the summary financial statements is part of the audit process and not considered other information, which typically includes unaudited materials presented alongside the financial statements. The auditor's primary responsibility is to check whether the other information included in the document containing summary financial statements is consistent with the audited financial data and to address any material inconsistencies. Although the misstatement may not directly affect the summary financial statements, the auditor should still bring it to management's attention and consider including a statement in the report to ensure transparency. When management refuses to correct the material inconsistency, the auditor must include a description of the inconsistency in the audit report to alert users of the discrepancy. Other information may include items such as unaudited financial projections, management discussion, or performance highlights, which are not part of the audited summary financial statements. If the auditor is aware that other information will be included, they must review it for any material inconsistencies before issuing the audit report on the summary financial statements. If the other information is misleading, the auditor should discuss this with management and consider disclosing the issue in the audit report to ensure the users are aware of the potential confusion. An auditor is considered to be associated with summary financial statements if their name is included in a report or if they have given explicit consent for their name to be used in connection with the summary financial statements. When an auditor is associated with summary financial statements, they must ensure that the summary has been derived from audited financial statements that they have reviewed and that the summary is consistent with the full audit. If the auditor is associated with summary financial statements that they have not audited, they should request that their name be removed to avoid any potential misunderstanding regarding their responsibility for the information. The auditor's primary obligation when associated with summary financial statements is to ensure that the summary fairly reflects the full audited financial statements and is not misleading. If the underlying full financial statements have not been audited, the auditor should refuse to be associated with the summary financial statements, as they cannot provide assurance on the accuracy of the summaries without an audit. If an auditor's name is associated with unaudited summary financial statements, it may give the impression that the auditor has provided assurance on the information, leading to potential misunderstanding and legal liability. If an auditor consents to be associated with summary financial statements, they must ensure that the summary is consistent with the audited financial statements and issue a report confirming this consistency. If the auditor is associated with summary financial statements that contain material misstatements, they must request corrections or withdraw from the association to avoid misleading users. Under SA 810, the auditor is not required to perform procedures related to events occurring after the date of the auditor's report on the full financial statements. When issuing a report on summary financial statements, if the auditor becomes aware of a subsequent event before the summary financial statements are issued, they should discuss it with management and evaluate whether the event needs to be reflected in the summary to ensure its consistency with the full financial statements. The auditor's responsibility for identifying and addressing subsequent events extends only up to the date of the auditor's report on the full financial statements. After that point, the auditor is not required to perform additional procedures on subsequent events. If a material event occurs after the auditor's report on the full financial statements, the auditor should inform management and determine if the event should be reflected in the summary financial statements to ensure they are not misleading. The auditor's responsibility for reviewing subsequent events ends with the issuance of the summary financial statements. Events occurring after that are not the auditor's responsibility unless the auditor becomes aware of something that was missed during the original audit period. If the auditor discovers subsequent events before the summary financial statements are issued, they should request amendments to the summary financial statements if the events are material and could affect users' understanding of the financial information. Once the summary financial statements have been issued, the auditor's responsibility for subsequent events ends, and they are not required to perform any further procedures on events occurring after that point. If a subsequent event occurs that could be material to users' understanding, the auditor should include a reference to the event in the report on the summary financial statements to ensure users are aware of its impact. The objective of SA 805 is to audit and report on a single financial statement, or a specific element of a financial statement, which is narrower in scope than a full audit of an entity's financial statements. Under SA 810, the auditor must ensure that the summary financial statements fairly reflect the information contained in the audited financial statements and are not misleading. Audits of government entities typically have additional objectives, including assessing compliance with laws and evaluating the entity's performance and use of resources. Auditors working in specialized industries must be aware of industry-specific regulations, risks, and accounting practices that may require customized audit procedures to ensure compliance and accuracy. Forensic audits focus on investigating and uncovering fraud or financial misconduct, and often involve legal proceedings. These audits are highly specialized and target irregularities. Auditors of specialized entities like banks or insurance companies need to consider specific industry risks and ensure compliance with relevant regulations. For example, liquidity risks in banks and actuarial risks in insurance companies are critical to such audits. Performance audits assess how well an entity manages and uses resources, aiming to ensure value for money. This type of audit is common in the public sector and focuses on efficiency and effectiveness. In the construction industry, revenue recognition is a key audit focus, as it is often based on the percentage of completion of projects, which can be subject to estimation and timing risks. Environmental audits focus on ensuring that a company is complying with environmental regulations and laws, and evaluating the impact of its operations on the environment. Due diligence audits focus on assessing the target company's financial stability, legal liabilities, and operational risks to provide the acquiring company with critical information before finalizing the merger or acquisition.